Hello, everyone. Good evening, good afternoon, good morning, depending on what time zone you're joining from. uh, Give me a couple of minutes. We'll get started soon. Make sure you have, you have some water with you. You got some pen and paper with you, and you reserve these 2 hours, next 2 hours. So we're gonna have a lot of fun. It's going to be, I hope it's going to be interesting session for you, but let's see. So before we start, which location you're joining from? Just wanted to understand, the geographical spread. I see Atlanta, New Jersey, San Francisco. Oh, that's pretty closer to home. Dallas, Texas. All right, who else? Is there anyone from outside of US? I know some folks had reached out to me. I'm not sure if the timing may be a little off for those who are joining from Asia, so not sure. But let's check. LA. All right, so let's get started. I think we have almost 40 people, and I want to be cognizant of your time. So let's get started. So welcome everyone for the options bootcamp. As the name suggests, we are here to learn more around options. This is specifically, when I say options, I am referring to the derivatives from on the stock market. So that's what our focus is. And today I'm going to just cover two topics. One is very basic introduction to what an options is, and a very, a newbie strategy of how you can use option to acquire shares. And, what's the pros and the cons. We'll go through certain scenarios. So that will be focus of our today's discussion. So since this is the first drill of the overall bootcamp, I do want to give you some introduction of what all we're going to cover in the subsequent weeks, so that you are, if it is for you or not, or is it too much for you, or how many sessions you may want to attend or not. All right. As always, whatever I say or do here is not a financial or tax advice. You really don't want to take a tax or financial advice from a tech person. So use this information for education, maybe a little bit of entertainment if you can find any, but more from a learning perspective. We are all here to learn from each other, and let's keep that spirit up. Okay. All right. So from an introduction perspective, I know a lot of you folks are joining from my Saturday meeting. You probably know me already, or you're joining from my LinkedIn profile. So we are already connected, you know me. But there may be many people who don't join the Saturday meeting, but just showed up in this one. So here's a quick intro about me. Before I'm telling who I am, let's talk about who I am not. Right? I'm not a trader with some simple indicators that I can give you a chart, or you can put those indicators on the chart, and you know exactly your entry point, exit point, and you become master of option after within a few sessions. That's not what I do. Also, and I don't have a mansion, I don't have a private jet, I don't have a Lambo. If you are interested in options, if you have been looking around for information in options on YouTube and all that stuff, you will see many traders, flaunting their Lambos or their lifestyle and talking about how they made tons of money using, options. So these are some of the tactics that they use, but I don't have any of those things. So sorry, if you're here for a Lambo, this is not the session for you. Okay. But who am I? I'm just like, regular guy. It's just like you and I. A lot of folks out here, you're all working to provide for your family. So am I. And it's not suddenly a light bulb or, overnight that I figured out how to use options to build wealth. It took me a few years to understand and to become consistent in using options to build a portfolio. And that's what I'm going to talk about in these sessions. Okay. My experience, like I said, I'm not from financial services industry. I'm not from a prop firm. I'm not from a hedge fund. I spent most of my life in tech companies, right? Especially on the fintech companies and few years on the data management, right? From an investing perspective, being an investor for 20 years, almost 20 years, first in India, and then once I moved to US, been investing in US 12 years, just as a passive investor, right? Just ETFs. Things that I generally have talked about during the Saturday sessions where we talk about stock and investing. And last 8 years have been a little more active. And my philosophy is I think about the risks before the rewards. And that keep me on the ground. So that's in a nutshell about who am I. So how did I get my start in option? 2015, 2016 was when I first started looking for options. And the reason was stock market was all-time high at that point of a time. And we were just entering into, in US, we were entering into election season. That was an election season for us. And as you would know, whether it is US or any other country, election year is generally very volatile. So I was really concerned about the upcoming elections, who's going to win, whether it's going to be red or blue, how's the market going to react? Should I sell my portfolio or should I just hold it, let it go through election volatility? What am I supposed to do? Right? And that's where I started looking for better ways to protect my portfolio while still staying in the market. Right? No one can time the market. Warren Buffett has not been able to time the market. And so I was just searching for how can I still stay in the market, but at least have some control over my portfolio in case the market goes against me. So that's how I started searching for what can I do. And, I came across options. And then as I got deeper into options, I realized you can use it not just to protect your portfolio, but also to generate, consistent income. We're going to talk about those things, in subsequent sessions. And that's it. I'm not a big on real estate, but I found another way to generate my rental income. Using my portfolio, you can generate your consistent income, call it as a dividend stream, call it as a rental income, call it as a monthly income, whatever. So, and then, that was how I got hooked. And haven't looked back since then. Been in this for almost 8 years now, and been talking about this for almost 4 years. Took a gap. I think this is my 5th boot camp. The last one I did was in 2021, and then I got back into, got into my job, and it takes a lot of time and energy to do this. So along with the job and, regular investing, I just didn't find time to do another boot camp. So now I'm back. This is our 5th session. So hopefully a lot of things I have learned in last 3 years that I have incorporated in this 5th session. So hopefully you'll find that useful, but that's a quick, brief background of how I got into options. Okay. So why am I sharing this for free? I mean, I hope none of you had to pay for this. I know sometimes I get a message saying, hey, your meetup's asking me to pay. I'm like, no, this is all for free. So why am I doing this? This is a person who you should thank. There's a sad story behind this. If you were active in 2020 or 2021 in US market, the name of this kid, Alex Kearns, was all over the financial media. This is a sad story behind this guy, right? Robinhood app was very famous. Everyone was downloading Robinhood. Everyone suddenly became investor/trader overnight. And this was a sad story wherein 20-year-old Alex Kearns, he took his own life because he had some option trade and his portfolio showed negative 730K balance. And he thought that's the money he owed. If you dig deeper into this, There's nothing wrong. There is no problem with his portfolio. He didn't owe that much money. And it was just a normal situation. It turned into a tragedy because of lack of education. And none of the brokerage firms, and I have had experience with many of them, with some of the biggest brokerage firms in US, TD Ameritrade, now Charles Schwab, Robinhood, Tastyworks, none of them do a good job of actually educating people, right? So that's when I decided in 2021 that, then you know what? Maybe I'll do it. And I'll do it for free so that we don't have this tragedy again. Learn about it and become more, informed about how to use options before you go deep into options. So that's how I thought I'm going to do that as and when time permits. So the so-called option gurus, what they were doing. So, these names, in 2020, 2021, you couldn't have watched any YouTube video without an ad from Raging Bull. All they were doing was scamming people. Right? Finally, they got sued by FTC, 437 million, because they defrauded all the consumers. In paper or in their ad, they will be talking about options, they'll be teaching options, but in reality, they were just scamming people. And now I'm seeing that this is happening not only in US, but in India as well. There are like seminars being conducted with hundreds of people, charging them tons of money. And I know some of the folks in my Saturday meeting, they came and told me that they have paid a few $1,000s for learning about options. And the content is even worse than what they've actually learned during the Saturday sessions. So same case in India, right? So if you are trying to learn options and anyone is charging you, run away. Look the other side. There's so much of a free content available on internet. There is absolutely no need to pay to learn about option. And if you'll be there for next 14 sessions, we have 14 sessions, I'm going to take you through everything around options, right from the basics all the way how to use it for managing your portfolio. All right, so how you can stay connected with me outside of this session. One is, if you're on Meetup, I do host a general investing meetup every Saturday. This is the group. Join the Meetup community. And every Saturday morning from 10 to 12, generally it actually goes beyond 2 hours. But yeah, that's a meetup wherein bring any questions related to investing, stock, bonds, IPOs, etc., etc. So that's one way you can stay connected. Otherwise, yeah, so this is just an example of, we just had our 214th session. We talked about what's happening with the gold, Amazon CEO letter, so on and so forth. Or there are other ways to connect with me is, I've recently become active on Twitter, or call it X, whatever. And so if you want to connect with me on there, you can. So let me just share this link. Or I have a YouTube channel, not that active. I just post the weekend videos over there. Or you can go to my website. This bootcamp recorded will be posted on the website. Plus, there are some other content over there. You can email me at vivek@optiongig.com. Or there's a Slack channel. There are a few, I would say, retail investors. We have a group of retail investors. Those are in that Slack channel. So if you are interested in that, let me share these links with you. No pressure. If this is your thing, if you want to stay connected, these are the various ways. Okay. Otherwise, we'll meet again here on next Wednesday. All right. So before we jump into today's session, a few things for housekeeping. get a notebook, get a pencil or a pen. I already talked about ask your questions in a Q&A. I'm going to use Thinkorswim trading platform as and when there's a need to use a trading platform. You could use any. I don't have any specific, I shouldn't say preference. I don't have any specific preference, but I like Thinkorswim because I've become comfortable with it for using over 8 years. Number two is there are a lot more information that I need as as a person dealing in options. Robinhood just doesn't have it. Don't get me wrong. They've got a great UI, but when it comes to more into options, they're not the best. My focus will be on a US market. I see there was a question, is the presentation only for USA? Not that case. Generally, some of the same concepts also apply to other markets, but I'm going to talk, the terms and regulators and how the stuff works on US market. Like I said, if you want to have any discussion between the sessions, use a Slack. I shared the link. There's a channel called Bootcanmp. It's time to revive that channel. No one has used it for last 3 years, but if you're interested, I do watch that. If you have any questions after the session, post it over there. I do not have a Discord, so don't ask me for Discord or a Telegram channel. I don't have any of those. And you get your homework, make sure you do it before your next meeting. So let's move on. Prerequisites. You should have a regular brokerage account because many of the firms that do not allow options on IRA or 401k. So it'll be good if you have your own regular brokerage account. Some of them do allow for IRA, but I don't know. You have to check with your brokerage firm if it allow options on IRA or not. Number two is you should have some familiarity with buying and selling of stocks. When I say stock, include ETF in it. Okay, I'm probably the word that I'm going to use throughout the presentation is stock, but that also includes the ETF. And make sure his account is enabled for options. Okay. So these are some of the prerequisites. You don't really need to know anything about options. Just to start with, that's what I'm going to cover in my session. Okay. All right. So what I'm going to cover in all this bootcamp. So there are going to be multiple drills and at different levels. So today we're going to talk about very basic introduction to options and a newbie strategy on how you can acquire shares using the option. So at the end of a day, I still want to buy and sell shares because I'm comfortable with that. But how can I use options to do a better job of just buying shares, right? Second session, we're going to talk about call options, how you can use it to generate monthly income, getting deeper into, exercise, assignment, concepts. And fourth session will be on, if you want to open an option trade, what are the checklists that you should go through? Let's focus a little more at a portfolio level. Okay. Then we move on to the intermediate level sessions. And we're going to talk about some small account option strategies. Right? Everyone starts small. And so we're going to talk about spreads. Number 6 will be how you can create an options portfolio. Using, I guess I'm going to take $25,000 account. And we'll probably build positions, a well-diversified portfolio using just options. Number 7 is where the more fun starts, is how do you even manage option trades? Something that you can't do in a stock. If stock goes against you, there's nothing you can do. You can either just hold it or sell it. In options, you can do some stuff. Then we're going to deeper into how the pricing works, how the assignment happens. And number 9 will be exit checklist, how you exit an option trade. And finally, going to move into the advanced section. And if you still have, or with me at that point of a time, the reason is that's why I'm doing once a week, because the content become really heavy. And I do want to make sure you have a week to process it and try some of the things out. We're gonna get into more details of what are the different trade-offs, what are the option Greeks, starting with the delta, theta, vega, gamma. I'm not gonna get into the second order Greeks, just the first order one. Then 13th will be how to use for hedging, how to use options, just like professionals use, like hedge fund managers use, prop firms will use, of hedging your portfolio, delta hedging, that's what it's called. And then finally, that's my favorite topic, is some tips and tricks for retail investors, right? I'm not going to talk about anything that need you to sit in front of your computer or your laptop, because I couldn't have done that. My whole investing journey has been focused, because I had no choice, I had a full-time job, is focused on how can we engage in a market along with our job. That means you got a meeting coming up in the morning, you can't just sit and monitor your trades. So there are a few tips and tricks, just coming from my own experience, how I had to learn, and that's the last one that I'll share. So if you are doing it for a full time, that may not apply for you, right? But for full-time traders, there's a lot more content available on YouTube. I just couldn't find anything which is specifically focused on folks who don't have much time to babysit their portfolio, which is where I was in that situation for many years. Yeah. Options, right? And there are a few things that I want to talk about in terms of what media says about options, right? Options are riskier than stock. And this is, before I actually got into it, again, my perception was based on what I read or what I hear. Or on the other side, you'll see options are risk-free, right? You can make tons of money in options. There is no risk in option, risk only what you put in. Or option trading is only for experts, right? Retail investors should not get into options. You have no edge. You are no match for Wall Street firms. Options are challenging to comprehend. I would agree a little bit on this side. It is not between stocks. When I say stocks, means ETFs or bonds, including everything. Options does need a little bit of education, right? And you'll make tons of money trading options. They don't talk about the other horror stories in which people have blown their accounts. Those only come once in a while, because no one wants to talk about bad things. Or the stock market collapses are brought on by options. Again, anytime you see an issue in the stock market, they'll blame zero DTE options. Nowadays, that's the favorite piñata of financial media. It's all the option traders who are causing this volatility. At the end of the day, it's just a tool, right? You can use the way you want to, and let's make sure we use this tool in the right way. Okay. Why I use options? Completely different reason. I will use options so that I can reduce the risk in my portfolio and not take on more risk. So options are not risky for me. These options are actually reduce the risk for me. I use it to generate income. I use it to provide me an opportunity to make money in every market situation. Market is moving up, fine. There are strategies that I can use. Market is moving down, you can still make money in a down market. You'll lose money in the stock side, and that's where I use options for hedging. Okay, I'm going to lose on the stock side because I can't do anything if the market is going down, but I can make money on an option side. You can construct those strategies. I can make, even if I'm directionally wrong, right? And we're going to talk about some strategy, which even if I thought I'm bullish on this one, I put in a bullish trade, stock actually went down, and you can still make money. You can fix losers without adding additional capital or taking on additional risk. So majority you are from stocks background because 70% of you mentioned that you never traded options. So what happens if your stock goes down? Holding the stock and you don't want to sell it because you don't want to time the market. The only way to reduce your cost of owning the stock is to double down, right? Well, let's buy more. The stock is at 100, went to 50, let's buy more. Let's put in more capital. But if you're putting in more capital, that you're adding more risk to your portfolio. Who is to say that the stock is not going to go down further? But if you understand options, you could actually reduce, or you can actually fix those losing stocks without adding more capital. Option provides me margin of safety for the stocks. Howard Marks talks a lot about margin of safety. Seth Klarman has a book on margin of safety, right? One of the best books around investing. If you go to Amazon, it's actually $2,500. You won't even find it now. You'll find out on eBay, maybe $3,500 book. And finally, it helps me to hold my favorite stock for the long term. I'm a firm believer that you can only build wealth in the market by staying longer in the market, not by getting in and out of the market. But I was scared of what am I going to do if the stocks go down? So options have helped me to hold my stocks irrespective of whether it's a bull or a bear. And in the last 8 years, I've survived, 3 bear market, 2018 December, and then 2020, 35% crash in S&P 500, and then 2022, whole bear market. I didn't liquidate my portfolio. It helps me to stay and hold my favorite stocks for as long as I want to. Right? So these are the reasons why I started getting into options, and these are the reasons why I love options. None of the reason is that I'm going to want to hit it out of the park, or I want to make 400% return or 200% return in the market. That's not what I want to do, because I know that that doesn't work in long term. Those are the lottery tickets. It'll work once, won't work 99 times, but that's all you will see on Twitter or on YouTube of how you can make those multi-100%. But no one's going to talk about that it didn't work for them for 99% of the time. So that's all lottery tickets, and I don't like lottery tickets. I mean, lottery tickets is for fun. Rather go to Vegas. It's not for running your business. So if you're really serious about running your business, you can't run based on the lotteries. So that's why I got into options. And also, the most, I would say, astute investor of our generations has blessed options. And you may be surprised at this statement, because both Charlie Munger and Warren Buffett generally will call derivatives as weapons of financial destruction, right? WFD. They said derivatives are bad. They're not good. No one should be dealing in this one. These are the weapons of financial destructions. That's what they say in public. Look into Warren Buffett 1994 letter. He talks about, I remember of Coke sometimes in early fall thereby. I don't know exactly when. He sold the puts on Coke. He got a premium of $7.5 million when the Coke was at 35. If this premium and the puts is a foreign language, stay with me. We're going to cover these puts in today's session. Right? But he sold tons of options on Coke. Then he talks about, there are securities I won't mind writing puts for 10 million shares or something. He's not talking about buying shares, 10 million shares. He's talking about writing options on those 10 million shares. And as late as 2007, the second category of contracts involve various put options that we have sold on 4 stock indices, right? Options that expire 15 to 20 years later. We have received $4.5 billion premium. So Warren Buffett has been using options for decades. Number two is his most important business that makes tons of money for him, which is Geico, is nothing but equivalent of selling options. And we're going to cover how that is. So if he likes it, I love it. So any questions so far on what we have talked about? Or has there anything that you maybe might have surprised you because, gosh, Vivek is talking something stupid. That's not what I heard about options. All good? Let me see if any other new questions came in. What's the name of the book? But that's not options book. There's a Seth Klarman's book. I think it's called Margin of Safety. Hey, what's the Slack channel? I put a lot of stuff on the. Oops, sorry. Oh gosh, okay. Let me just put it again. All right, I just shared the links. Just confirm. Did you get that, Priyanka? Let's talk about options and the very basics of option contract. So far we have established the fact that options are not bad. They're just a tool. You need to know how to use it in the right way. If using it the right way, it could enhance your portfolio returns. It could help you to stay invested in the market for longer. It could help you to cushion the losses that you may be facing in your long stock positions. There will always be bulls and the bear market, right? That's what the markets are. One day it will be up, next day it may be down. Now this week, you'll be having a red week. This year, we had a great year. So how do you stay invested is what options help me. So what's an option contract? It's just a legal contract, right? It's a legal contract between two parties in which one party agrees to either buy or sell a security to another one at a fixed price. So you and I, we already agree on a price, and that price will be valid up to a certain amount of time. That's all. It's a contract between two parties. We do this contract on your brokerage platform. Everything gets executed electronically. So things to remember is it's a contract between parties to buy. It could be a contract to buy the share at a fixed price up to a certain date. After that date, contract will expire. It's that contract is no longer valid. Or it is to sell the security. So two parties, one is writing the contract, the other one is buying that contract. So building blocks. Two building blocks, one is called put, another one is called call. Okay. Don't have to read through this content. We're going to have two separate sessions on what a put contract is, what a call contract is. And however complex, so these you can call it as atoms of option strategy. Doesn't matter what, what option strategy you're going to use. At the core level, those can be broken down into puts or the calls. Just like any matter that exists in the universe can be broken down into atoms. These are the two atoms of any option strategy. So if you're looking into an option book and you're seeing strategies like put spreads, iron condors, straddles, strangles, broken wing butterflies, iron flies, Batman, jade lizard, back spread, ratio spread, zebra. Don't get overwhelmed. As long as you understand what a put is, what a call is, or you can construct any of those strategies, or any complex strategy can be just broken down into puts and the calls. These are the only two Lego blocks that we have to build an option house or even an option city. Okay, so it's important to spend time to understand these two very clearly. So let's take an example of an option contract in real life. Right? Say Martha, she owns a Rolls-Royce Ghost, great car, but they're pretty damn expensive. So that's worth $500,000 car. Now, just like you and I, she also would buy an insurance policy to protect the car. Right? In case the car gets damaged, she can get $500,000 from her insurance policy. Matthew comes along. He's an insurance agent. Say, you know what? I'll offer you the insurance policy on this car, but you got to pay me $40,000 as a premium. Fair enough. We do it all the time, right? We all have a car insurance. So that's Matthew. He will write an insurance policy. Martha will buy that insurance policy, right? And Matthew gets the cash from Martha. That's done. You can substitute Matthew with Geico, AAA, State Farm. I don't care whichever insurance you deal with. And this is an example of an option contract, right? And I'll explain you how. But why do we get into this contract? Right? Why would Martha want to spend $40,000? Her viewpoint is, gosh, if anything happens to my car, if it is irreparable damage, I can get my $500,000. I know it works a little differently. You know, they'll ask you to buy a new car. But let's say the insurance company says, hey, we protected you for $500,000. Damage the car, it is totaled. Here's your $500,000. And as an owner, Martha, she bought a peace of mind. She doesn't want her car to be destroyed, but just in case. There are a lot of crazy folks out there on a highway. You know, you don't know what they've been drinking, what the state is. They could total your car. So she bought peace of mind. She protected her $500,000 asset by buying an insurance policy and paying a premium of $40,000. If that's the case, why would Matthew want to sell it? So Matthew's viewpoint is what the insurance company's viewpoints are. They have actuarial tables. They have statisticians working for them and looking at all the data. And they know that for a car in this zip code with certain owner characteristics, the damage is less than $40,000. And I got a premium of $40,000 from Martha. You know, anything happens, I'll get it repaired. And, I'll retain some amount of that 40,000 because statistically, the damage is less than the amount of a premium that I have received. So that's why Matthew is willing to write that insurance premium. If it is in a high risk category, he'll probably gonna demand more than $40,000. I remember, I don't know if it's still true or not. It like 10, 12 years ago, my friends told me, don't buy a red car because red color cars are red is the most, stolen car, red cars. So your insurance premiums goes higher because that is higher risk. So this contract, let's bring it home to our options side. This is an example the example that happened between Martha and Matthew is an example of a put option contract. So Matthew wrote a contract or a policy, call it as an option contract. He sold it to Martha. As per policy, Martha can put the car to Matthew, or get $500,000. Add $500,000. So the car is total. Take the car, give me $500,000. She bought that right because she got that policy. Within 1 year, that's the expiration period. And for this consideration, she paid $40,000 premium to Matthew. So options are they are not complex. This is an put option contract. Matthew is writing that put option contract. Martha is buying the put option contract. So if you buy a put option contract, it gives the right to the buyer of the contract. It gives them the right to sell a stock. Now let's substitute the car with the stock. So it gives Martha the right to sell the stock at the predefined price within a specified time period. Just like the option, the insurance contract gave right to her to sell the car at a predefined price within a predefined period. Now, in insurance contract, most of the time the period is 1 year. In options, the period is different. I mean, you have a 1 year, you have a more than 1 year, you'll have a weekly, you'll have a monthly. But that's all the put option contract is. There is no rocket science. But to get this right, Martha had to pay a consideration, which is what in option world we call it as a premium paid on that option. And she pays that premium to the option seller. So there are always two parties to any contract: buyer, seller. I'm talking about who is buying the contract, not the underlying stuff. Underlying is the stock. So if the option buyer is buying the contract, option seller is selling the contract. Now, what that contract allows to do could be different things. In put option, that contract allows buyer to put the stock at the strike price up to the expiration period. Okay. I know I'm going slow. The reason is 70% of you have never traded options. That's why I'm going to go a little slow so that it is clear to you. Okay. And now when the option buyer is putting the stock, the seller is obligated to buy the stock. Insurance company can't say, oh, you know what? I'm not going to buy this car from you. It's damaged and pay you that amount. No, it's a legally binding contract. Gosh, you got the premium for me. Now I ended up into this situation. I want to sell the stock to you. You better buy it. And the seller has got an obligation. Buyer has got a right. Okay. So two things that you'll hear dealing with options is exercise and assignment. Pretty easy to understand. Buyer has a right to exercise the terms of the contract. And the terms of the contract would be, you can put the stock, and the option seller will be assigned those terms. So he will have to execute on those terms. Okay. Example would be Martha had a right to exercise it, and the option seller will be assigned the contract. Okay. Right. I see a question, depend us who have actual stocks similar to Rolls-Royce cars. Yeah, look at a Berkshire Hathaway. That stock is maybe, I think, 600K now. Okay. If nothing happens, what happened to your insurance contract? It expires worthless. And then we renew the contract again for next 1 year. Does the insurance company gives us the premium back? No, they just keep the premium. So if nothing happens in case of stock options, the seller just keep the premium and we say this contract expired worthless. So that's all. Any questions so far? Okay. All right, let's continue. So don't get overwhelmed by the amount of data in the screen. Just focus on some of the elements I'm gonna find out now. Okay, so what are some contracts, the elements of an option contract? One is obviously what's the stock that I'm writing this contract on. In Martha's case, it was a Rolls-Royce car. She could have a Maserati, who knows, right? So in this case, it's a Google. For now, just only focus on the right side because we're talking only of puts. So I'm not going to get into the call side of the house. That's for later session. So important is what's the stock? So that's a Google. What's the expiration date? In this case, the expiration is 17th May 24. What's the price that we have agreed upon? This case, the price is $150. And what's the premium, which is denoted by the mark, is $4. And what kind of a contract it is? It is put contract. So if I buy or sell this put contract, then if I'm, let's say, buying this put contract, I am buying a right to sell the stock. You bought a contract, but that contract gives you right to put the stock. And this is how, became easy for me to learn. Gets a little confusing. You bought the contract to sell what? To sell the stock? So buy, sell. So I said, instead of saying sell, I'm like, because the put contract, I bought a put contract so that it gives me a right to put the stock at 150 till 17 May 24, and the stock is Google. And for this, I paid $4. So that's all the elements of any option contract that we need to understand. One more thing is, Rolls-Royce is just one car. When it comes to the options on stocks and ETFs, options are actually also exist on futures. I'm not going to talk about futures, but on stocks and ETF, each contract has got 100. It trades in units of hundreds. So means if you are buying this contract, you are buying a right to put 100 shares of Google. So that's where it's shown, like there are 100 shares under this contract. Or if you are selling this, means then you'll have to buy 100 shares of Google. So these are the main, I would say, elements of any option contract. Okay. All right, so let's move on. Any questions so far? What's the stock ticker? What's the underlying ticker? It's Google. How many shares are included in it? 100. There could be some cases, and I've seen maybe handful of cases in which it is not 100. Majority of the time, I would say 99% of the time, there are 100 stocks underneath under one contract. What's the date of expiration? When does this contract expires? 17th May. On 18th May, my right is gone. I don't have any rights. It's just like if your insurance expires and the car gets damaged a day after insurance, it's over. Your insurance is no longer valid. Strike price, 150. That's the price that we agreed upon to trade the stock. What type of contract it is? It is put contract. And the premium amount, whatever, was $4.05. And Google was currently trading at 155. No, when we looked at this. So Google trading at 155.23. I see a question. Cost asks, what happens if I don't have enough money to buy the 100 stocks as a put seller? We'll talk about it in session number 5, where we talk about spreads. You don't need to buy, you don't need to have $15,000 stocks because you want to trade in Google. You can actually get a bullish position in Google for as little as $1,000. Right? Or let me put it the other way around. Say you want to trade in Chipotle. Chipotle is $3,000 stock. If you have to buy one stock, you have to pay $3,000. If you want to, if you have only $2,000, you can't trade in Chipotle stock, but you can create an option strategy that will allow you to have your bullish or bearish viewpoint, whichever way, using option. So we're going to talk about that, I think, first session of intermediate level, which is focused on small account strategies. What if I don't have this much amount of money? I'm just beginning and I have only $5,000. What can I do? There are ways to do that. All right. So I call it a PC box. Again, this is a learning. After 3 years, I didn't have it in my previous presentations, but you learn. So pull out your paper and pen or pencil and draw this box, please. And we're going to fill this box. Believe me, it'll be very easy to understand and create a muscle memory of what happens when you put in the buy, call, and the sell, how those things work out. It took me a lot of time. So I used to have a Post-it at my desk or diary at my home so that I can continue to look at it, because what does that mean? If I'm selling a put, whatever, is it bullish, bearish? Selling a call, bullish, bearish, because there are two things involved. You don't have that problem in the stock. Stock you buy, you're bullish. That's why you're going to buy the stock. If you're going to short the stock, and again, 95%, 99% retail investors don't short the stock. They only just are bullish. But if you are those 1% who want to short the stock, you're bearish. Okay. Here, when it comes to options, you can use puts for either bullish or bearish. So make sure you've drawn this box. And next few sessions, we're going to fill this up. And that's what you can use it at your desk until it becomes a muscle memory for you. And then you can answer in sleep if someone asks you that you sold a call, are you bullish or bearish? Okay. Until then, have this piece of paper. Okay. So let's talk about, today we're going to focus on put. So let's talk about buying a put. What happens to buy a put contract? This is the case of Martha that we already discussed, that she bought a put insurance policy, means she bought a put contract. It gives the buyer of the put contract to put the underlying stock, Google, at the specified price, which is 150, anytime or on before the expiration of contract, which was 17th May 2024. For this right, you pay a premium. For Google, you paid a premium of $4. Now, why would you buy put? As a form of insurance for your stock position. So you hold 100 shares of Google. Now, Google is coming up with earnings. And Google has not been doing good with their AI. I mean, they had 4 false starts on their AI. And you're worried because you hold, Google is a big part of your portfolio. What if Google goes down? Today, Google is trading at, I don't know, whatever, like 155 when I took the screenshot yesterday. What if Google goes down to 130? What if it goes down to 120? What if it has a 15% drawdown? So if buy that put option contract, that will give you right to sell the shares at 150, no matter where Google goes. That's one reason that you may want to buy this put option contract. I'm not saying that you should, but I'm saying this could be one reason why you may want to buy it. You are protecting your stock position. So this form is called protective put or married put, if you are coming across these terms. Then let's say on 17th May, if Google is at 120, I'll be happy that I had this protection. I'm gonna use this right and sell the damn Google at $150, even though in the market it is trading at 120. I'm gonna exercise my right to sell it at 150. Yeah, I mean, I paid $4 for that right, but really, really worth it, right? Otherwise, Google is not trading at 120. So that's one reason when you may buy this put. Could there be another reason? Another reason is if I'm bearish about a stock. Say I don't own Google. In the case that we discussed, in married put or protective put, I am not bearish on Google. I'm bullish on Google. But just in case, if anything happens during earnings, I want to protect myself. But I'm bullish on Google. I'm holding Google stock. Now talk about the next one. I am bearish on a particular stock. Let's say it's me, not you. I don't own any Google. I don't have Google in my portfolio. But that can't, I can still go and buy a put on Google. Reason is my friend, I shouldn't be saying that my friend had told me because that's going to be insider information. Reason is I looked at a Google, I looked at the misstarts and the misfits that they have been having in AI. They lost the game on AI. They tried Gemini, and I'm not hearing anything new from Google. Their search is being challenged by, by ChatGPT. The 10 blue links no longer work. And now Google employees are protesting against their support for Israeli government. They may pull out from some contract. Palantir is eating their lunch in the government contracts. I don't think Google gonna go anywhere. They're gonna have a bad results, guys. So what I'm gonna do? I am bearish on Google. I'm gonna buy the $150 put option contract. So stock goes down to 120, 17th May. What I'm gonna do is buy the stock at 120 from the market and use this right which I have from this put option contract to sell it at 150. So net, I made $30 minus $4 that I paid to get into this contract. I made $26 per Google share. So these are the two reasons for someone who may buy a put option. But did you see the difference? Generally, people say you bought a put option, you're bearish. No, that's not the case. And that's why you should never follow someone on internet thinking that if they bought a put option, they are bearish. No, you don't know what the rest of the position is. So in case of protective put, which is this we bought for Google, I'm actually bullish. And when it comes for a bearish sentiment, then I'm bearish. So similarly, let's say you don't have Google, this is the example of SPY. I'm doing a protection for, let's say, next 1 year. SPY is at 505. Okay. Now this option contract expires on 31st March 2025, next 1 year. Say I've invested in this SPY and I need to make sure that the money is available because that's a fund for, pick a cause, for my kids' college. Or you can pick up whatever reason, right? Something that you really, really need to have money for, maybe for a medical procedure. And I want to make sure that on 31st March 25, I will have an ability to sell my SPY position at $505. I don't care where the market will go. In that case, I could actually buy this SPY put option contract, which will give me protection all the way till 31st March 2025. Today, I have to pay $2,500 for one contract. Means for protecting one share, I have to pay $25. For protecting 100 shares, which is part of a contract, each contract will be $2,500. I can use this. I'm not saying this is the right way to protect the portfolio, but this is a way to protect a portfolio. We're going to discuss later on, once we get into portfolio hedging, what may be the right way. Now, this one is similar example of Google. I don't hold any SPY, but I'm bearish on it. So I'm going to go and buy a put. So this is called a naked put because I don't have any stock to go along with it. So it is naked or uncovered because there is no stock behind it. So let me address some of the questions on this. Okay, so looks like there was cost at asked something. If it expires in the money, I don't know at what point of time that was. Anonymous asks, how does the math work in this example? Why would someone want to sell it at 150 if it is trading at 155? Remember, trading today at 155. But this gives me a right to sell the stock at 150 all the way up to 17th of May. So I still got 17th of May, means almost 30 days. I'm buying this right for next 1 month, in which Google is going to report earnings. And I think the earnings could be bad. So then that's why I'm buying this protection, so that I can sell it at 150 up to 17th May. I could have bought it at 155 also. Today it's trading at 155. I could buy an option contract to sell it at 155, but then I'll have to pay whatever, $6. You can pick any strike price. It's just that, what do you think? What's your outlook about Google? Do you think it's gonna, do you need to protect yourself beyond 140? So there are ways to look at what strike prices you want to choose. We're gonna discuss it in subsequent session. But for now, I just want to focus on that you got what's a put option contract is. Is a premium just $4? 4 into 100 stock. It is 4 multiplied by 100. What happens? The stock goes higher, option contract expires worthless. So that $400 you paid is gone. You don't benefit from it. It's just like what happens if your car doesn't get damaged. Nothing. The premium you paid is gone. You lose that premium. In case of 1 year put, what is the stock goes high, then the premium that you paid has not worked out for you. But will I be sad if I bought my car and paid a premium, car didn't get damaged? Am I going to be sad about it? No. I don't buy insurance thinking that my car should get damaged. So yeah, so that money is gone. So money is taken away the moment you trade in this option contract. So the moment you buy the option contract, $400 gone from your account, and option seller, they receive $400 right away. Okay. All right. This one. Anything else on buying put? In the Google example, is the idea to buy again 120 right after exercising the put option at 150? Otherwise, we can always hold when the stock is down, right? It's up to you in terms, do you want to buy it at 120 again, or what do you want to do? I mean, In this case, let's say in the real scenario, instead of me trying to sell the shares and do a capital gains tax, real life, the value of this contract becomes much bigger. So I paid $4 to buy the contract. If a Google goes to 120, this contract will be worth almost $30. So instead of selling share, I will basically sell the contract itself and get $30. So instead of, I'll benefit $26 on the option contract itself and won't sell my shares. So again, these are the things that we'll talk about. I'm not sure if I'll get into today's session. Is it how just we predict the price will be down? It's about what outlook do you have about the stock. And if a price is down, should you buy a put? I'm not saying this is the right strategy. It is a strategy because I don't buy puts. Most of the retail investors and buying puts doesn't work in the long term. So I'm not saying this is the right strategy. Or can you explain the difference between naked put and long put? So terms, long means you're buying something. Long put means you bought a put. Now that put could be married put because you already hold the stock. Or it could be naked put because I don't hold the stock. So in case if I'm holding Google shares in my portfolio and I buy put, I go long on a put, then it's a married put. It's a protective put. If I just bought a put, it's a naked put. Rajesh, can you please discuss a bit more about the last slide? Okay. So I don't know what's the exact question. Meanwhile, let me just go to next one. You ask, can I buy long-term call and sell a put expiration within a month? Yeah, you can do anything. You can buy a long-term call, sell a put, but remember, again, I'm going to talk about the terms which we haven't yet covered. You're getting a lot of deltas in your portfolio. Is that what you want to do? Sure. Go ahead, express your opinion. When you say retail investor, can you elaborate, please? Yes, if it is not clear until now, my apologies. When I say retail investors, I'm talking about DIY individual investors who are not full-time into this, who have their other jobs to focus on, and investing is their they're trying to invest on the sideline. So they are not from hedge fund, they're not prop firm, they don't work on Wall Street. Wall Street will they're not professional investors. All right. So let's fill this box up. If you're a naked put, means I don't hold Google stock, I bought a put on Google. Only reason I'll buy it because I'm bearish. I want to express my bearish sentiment on Google. Protective put, if I own Google shares, which you may not know, and I buy a put, I'm still bullish about Google. I don't want Google to crash. It's an insurance that I'm buying. And if you buy an insurance on your house, you don't want your house to burn down. Right? So those who've been in options for some time and watching option flow, there are softwares available. They'll tell you, watch the option flow, watch where puts and calls are going, how the put call ratio is going. They tell you nothing about sentiment of whoever is trading because you don't know what else they have in portfolio. And I've seen a lot of retail investors getting sucked into this and say, so many put option contracts, the put call ratio is 2:1, means there are twice as many put option contracts traded on pick a ticker XYZ than call option contracts. It means market is sensing that it's bearish. No, that's incorrect because you do not know what the rest of the position is. Buying a put could be bearish or bullish depending on what else the trader or hedge fund may be holding. So if you see an hedge fund selling put or buying a put, don't assume by default that they are bearish. Irrespective of whatever you see in the media, majority of folks don't even talk about this. But the reality is you need to know what else is there, which you don't. And that is why I do not focus on put call ratio. I know some of you have asked me a question on Saturday webinar. Do you watch put call ratio? No, because it doesn't give me any information. I don't have the rest information with me. That's the reason. Okay. Am I obligated to buy a stock in a naked put scenario? If you sold the put, I'm not talking about selling. Right now, we're only talking about buying. If you sold the put and you will be assigned, and we're going to talk about, so let's hold on this question. And we're going to discuss on selling a put. If you're buying a put, you have no obligations. You have a right. You may choose to exercise the right or not. I mean, you will exercise it because that's why you bought the option contract. But and you can exercise it at any point. You don't have to wait until the expiration. Protective put as an insurance to curtail loss. Yes, to curtail the loss. Yes, exactly. Now there are some questions around the premium percentage. A great question, Vishal. And that is why I don't like I said, it is a way, not my preferred way of protecting the portfolio because the cost is high. And the cost will depend on the volatility and a lot of other factors. We've not yet gone into option pricing. So 2.58% premium to protect for next 30 days. Yeah, it is high. That is why it is not my preferred way of protecting the portfolio because you pay up too much. But it is a way. Okay. Now, what is a fair percent? I don't think anyone can tell. There is a way to find out. Now we are talking about a much deeper concepts of implied volatility, rank, etc., which will tell you is the premium on Google higher than generally it has been, or it is lower than generally it has been. And there are factors that determine that premium. We'll get into, when we get into option premium pricing, I'm going to talk about all the factors. So let's not jump into it right now. So I'll read the question. Anonymous asks, if I think a stock is going to go down, then instead of shorting the stock, I can do a naked put? Yes, you can buy a put. Do you show how to buy put as a practical exercise? Okay, yeah, we'll do that. All right, so let me fire up and bring up a paper trading platform. Okay, and then we already 7:30. Probably gonna run 15 minutes over. Okay, so this is a paper trading platform. This is, let's say, PayPal. You see Thinkorswim? All right, you guys are able to see Thinkorswim platform? Okay, cool. So let's say I want to buy PayPal. Or let's stick to Google. PayPal I introduce later. Go to Google. First thing you need to look at there's something called option chain. I go to the option chain and on different softwares, it may be displayed differently. Here I go to option chain, then I want to go to my expiration period. There are different option contracts for different expiration period. I'm going to select 17th May. Come to the put side. Left side is calls. Right side is put. And I'm going to pick up whatever my strike price is. So far, we've been talking about 150 strike price. I'll pick this. This will say I'm going to buy one contract. Symbol is Google, expiring on 17th May. Strike price 150. It's a put option contract, and this is the limit price. I'm going to log the limit price and send the order. Right? Then Thinkorswim will tell me, okay, what's the impact? Boom, done. If you're doing it in your real account and the market is active, your order gets filled. You bought a put option contract. That's it. I mean, just like you buy any shares, but instead of, if I have to buy shares, I will come here and say ask, and on top I have a shares, and there it says buy stock. It's not saying buy put, it's a buy stock, and I'll buy the share. Just like you buy a share, you could also buy an option contract. All right, let's talk about selling a put. So selling a put means now I'm a selling a put contract. So remember, Martha bought a put contract, insurance contract. Matthew was selling that contract. Now we are talking from terms of Matthew. Selling means if I'm selling a contract, I'm giving right to Martha to put the car to me. In case of Google example, I'm giving right to someone else, whoever is buying the contract, to sell the Google share to me at $150. And for that, I received a premium of $4. And I have an obligation to buy the stock at 150 whenever the other person wants to exercise their right. Okay. So that's called selling put or going short put. Okay. I'm giving away the right to someone to sell the shares to me, okay, at the price that is specified in the contract. Rest of the stuff remains the same. Okay. Now, as a option contract seller, I receive the premium. Now I'm an insurance company here. So if you're selling an option contract, you're acting like an insurance company who is selling an insurance contract. And as a consumer, you buy an insurance contract. Right? But if the car gets damaged, if my stock gets damaged, and the other person wants to put the stock to me because now the Google is 120, it is damaged from 155 to 120, I'm obligated to buy it at 150. I can't say, no, sorry, I'm not going to buy this. No, that's not how it works. It's a legally binding. And I got paid $4 for taking on this obligation. Okay. So why would I sell a put? One is if I am bullish on the stock. Now, this may be a little tricky to understand. Right? If I'm a bullish sentiment on a stock, I may sell a put. I'm going to take some example, right? Or to acquire the shares at a lower cost. And this is what I'm going to focus on. So one is I'm a bullish on SPY. 31st March, let's go back to the same example of SPY. 1 year later, instead of now buying this put option contract, I'm selling this put option contract because I'm bullish on SPY. Man, economy goes up. I have faith on US economy, I have faith on US companies, and I know that Spider is not going to stay at 505. It'll be higher than 505 a year down the line. So if I sell this, and I know that it's going to stay higher, I'm going to make $25. Because I'm bullish, I think the stock or the underlying is going to stay higher than this. So I'm expressing a bullish sentiment on this. Take an example of Google. I have sold a put option contract on Google to Martha because I know I'm bullish on Google. I think it's going to stay above 150. So Martha bought an option contract from me. I know this option contract going to expire worthless. So I'm going to read the $400 that I got. I'm going to hold it. That's money for me to keep. This is what insurance companies do. Right? They have a statisticians. They have actuarial tables. They know that the damage won't be, the damage to the car or damage to the share may not be what the insurance premium is suggesting to be. The damage is going to be less than the premium that I've received. So if you sell a put, you could be expressing a bullish sentiment, right? Again, that is the same option contract. The difference is between buying and selling. And the sentiment reverses. Or what Warren Buffett had done. Remember 2007? We looked at the slide earlier. He sold various put options on 4 indices like S&P 500, and those were for the terms of 15 to 20 years. That's what happens if you have like hundreds of billions of dollars. Wall Street will create option contract just for you. I can't sell at 15 to 20 years, but they created just for Warren Buffett. He sold put option contract because remember 2007, great financial recession. Everything was down. And Warren knew that it's not going to stay that way. So he was sold such a lot of put option contract. He received $4.5 billion in premium. I'm just talking about $4, right? $400 in premium on Google. He received $4.5 billion in premium. In 2007, when he sold this, which he can then use in his business. And he doesn't have to, and that contract is valid for 15, 20 years. And he knew that in market is gonna definitely stay higher than where it was in 2007, in 15 years later. So 2007, and that makes, we're already beyond 15 years. Now the 20-year contract is coming to expiration in 2027. So he made his money. He got his $4.5 billion. Right. So, and because he was bullish. So $4.5 billion is for his to keep. And which he got on day one and would have multiplied that $4.5 billion in last 15 years, 16 years for now. Okay. So if you're selling, going back to our put call box, selling a put is bullish. Whether I have a stock or not, if I'm selling a put, I'm bullish. There's no other reason for me to sell the put. The other reason, one was this that we just covered, to express the bullish sentiment. Like Warren Buffett expressed his bullishness on overall US market because he sold puts on a overall indices. You could do it against a particular stock itself because you're bullish on the stock. Or you could do this to acquire shares at a lower cost. It's similar stuff viewed in a little different lens, which as a retail investor, as a DIY investor, we are comfortable in buying and selling our shares. And I'm going to say, sell a put option. And we're going to compare that with just buying and selling our shares and which one is a better way to do it. Okay, that's going to be our next section. Like I said, I'm going to take maybe 30 minutes. So we might be over by 10 to 15 minutes. I hope that's right. You guys can hang on. Especially thank you to the East Coast folks. I know it's almost 11 p.m., but I really appreciate you guys joining. Okay. All right, we'll skip this. We talked about this as a legal contract. Buyer has a right, seller has an obligation. Option buyer will exercise, seller get assigned. If it is nothing happens, it is expired worthless. Each option strategy, you can create whatever complex ones. Basic building block is put in the call. If you can fill up your PC box and understand what's happening, you will be able to understand every type of option strategy. So let's take 5 minutes break. I need to drink something and maybe stretch a little bit. And then we're going to get back here. All right, let's go. All set. All right, Newbie strategy to acquire shares, right? Now I'm focused on, and this is how I got started was, guys, I don't want to deal with these option stuff, right? Everyone's saying so bad and all that stuff about it. I just want to buy and sell shares. Fine. If you only thing you want to do is buy and sell shares, great. You can still use options. So today, next 20-25 minutes, we're going to talk about how to use options to buy the shares. Okay. As a retail investors, what do we do most of the time? We buy stocks to get long, right? Like I said, 99% of the retail investors, they are long. There are very few short sellers. And if I don't like the market price, what I do? I'll go and put a limit price, right? So say going back to, let's take PayPal, because I think I have PayPal example. PayPal is trading at 63.49. I don't want to pay 63.49. I want to pay $60. What I'm going to do, 100 shares. I'm going to change the price to 60. And I say it's a limit order. And good till cancel means unless I cancel the order, this order is good, right? And that's what I do. That's what you guys do, right? As a retail investor, that's what we've been doing for years. And then I wait. I wait. Today, the stock is at 63.5. Didn't go to 60, won't get executed. It's good to cancel order. So tomorrow, stock is still above 63. Nothing happens. I don't get the shares. Fair enough. This is what we've been doing it. There's no rocket science in it, right? If you bought or sold shares or ETFs, that's what you've done. Example I took, if the stock stays above limit price, nothing happened. Your portfolio, I mean, if you had $6,000 cash, you still have $6,000 cash. If a stock goes below the limit price, your order gets executed, $6,000 moves out of your account, you get 100 shares of PayPal. Here's one way to use options better than limit order, to sell a put option. We just looked at selling a put option, right? Example, I am bullish on PayPal. I don't want to pay the 60. Yesterday it was 63.75. But I'm okay to acquire the shares at PayPal at $60 because I got $6,000 cash. I have two choices. One we already discussed. One that I've been doing for years is put a limit order. Other is, which I'm now advocating, maybe sell a put option at 60 strike price. Remember what happened if you sell a put option at 60 strike price? Going back to the same chart, you get $2 as a premium. Now you are selling a put option contract, the last part of a previous section. You're giving someone else a right to put the shares to you at $60, which you are okay to buy. You want to buy the stock at 60, but if you put a limit order and nothing happens, then actually nothing happens in your portfolio. You just wasted your time. In case of a put option, you actually got paid $2. Okay. So let's look at the mechanics. You sell an option, and depending on the trading platform, you may be having something called sell to open. You pick up your ticker, 100 shares are included in a contract, pick up your date of expiration, strike price is 60, premium is $2. So let's look at the first scenario. 17th May, now we are in 17th May 2024, end of the day, end of stock trading day, end of trading time. Stock stays the same, nothing changed. If you have a limit buy order, you don't get the shares because stock never went below 60. You didn't get compensated for the time. You have zero profit. Your portfolio started at $6,000. It stays at $6,000, zero return on capital. You sold a put option. You still don't get the shares. Because no one will be selling the shares to you at 60 when they can sell in the market at 63.75. But remember, you got $200 at the start when you sold the put option contract. That's your to keep. That's where you say the option contract expired worthless. So if let's say today you sold that contract, you got $200, your portfolio is $6,200. You still net positive return on capital. You made $200 for waiting for 30 days on a $6,000 capital. Let's look at the other scenario. Stock goes down to 59. Limit order case, you'll get the shares. You'll get 100 shares at 60. But since the stock is at 59, your overall portfolio value is now 5,900 because you have 100 shares. Right? So your portfolio is losing $100 because you started at 6,000. Now it is 5,900. In this scenario, your portfolio value is 100 shares of PayPal trading at 59, plus you received $200 earlier as option premium. You're still positive. Stock has gone down, but you are still net positive. Isn't that beautiful? Right? Why would I not sell this? Look at the third scenario. Stock actually goes up. Nothing happens in limit buy order. You started with 6,000. Stock never went down below 60. So order didn't get executed. Still holding $6,000 in cash. Put option, same case. You got $200 when you sold the option contract. Didn't get the shares because the stock is at 65 on expiration. But you still have net positive because you made $200 at a $6,000 investment, 3.33% for 30 days. Fourth scenario. Stock is down to 55. Limit buy order, you have 100 shares. Your portfolio is now worth $5,500. Fair enough? Because stock went down to 55. You started with 6,000, now it has $5,500. You're actually down $500. Look at an option contract here. Gets 100 shares at 60. Your stock value, 100 shares of PayPal, is $5,500 plus $200 you got at the premium. You're still losing, but losing little less. This is what I call as a cushion. This is what I call as a margin of safety. This $200 premium that I receive is my margin of safety. Right? Great investors talk about it. Get a margin of safety. This $200 is my margin of safety. It protects my portfolio from drawdowns. Instead of staring at 500 drawdown, I'm only had $300 drawdown. I can't control what the stock can do tomorrow. I can only control how I want to express my bullish sentiment on the stock. So why would I not sell an option contract, put option contract? Why would I go and buy the stock immediately? So this is called cash secured put because you're holding that cash, you're blocking that cash so that in case the stock is put to you at $60, that contract is secured by the amount of cash you hold in your portfolio. So instead of putting a limit order, sell a put option. You choose what's the right strike price that you want to buy the stock. Say you're not happy with 60. You say, I want to buy at 55. Fine, you get paid almost 92 cents. And if stock doesn't go to 55 at the end of expiration period, you already got $92. Use it for dinner. Use it for whatever way you want to. That's what, if you dissect Warren Buffett's business model, that's exactly what it is. Most of his money is coming from his insurance operations, right? Geico, as well as reinsurance, right? Property and casualty, CAT insurance, catastrophe insurance. What they do? They'll sell an insurance contract, get the money up front as a premium, and invest in the other operating businesses or is in other investments. And they run their numbers saying, I mean, it's a beautiful business. They have almost zero cost of capital. So you get your $100 here. Now do whatever you may want to do with that $100. And you are willing to buy it at 55. And that's why you put in a limit order, but you don't get paid when you do a limit order. But in this case, you actually get paid. So you choose for how long are you willing to wait. So if you're willing to wait longer, you may get paid more. But then you also have a risk of maybe the stock could go to 35, maybe some, longer the time period, higher is the uncertainty. And that's why higher is the premium, right? Higher is the risk in a certain area, higher the car premium, higher is the risk in a stock, higher is the option premium. It's as simple as that. So here, if you go down further, let's say to July, for $60, you're getting paid $3.25. But anything can happen from now on July. Maybe they'll fire the CEO, right, in May, and then the stock will go down to 40. Who knows? And because there is longer time period, because there is more uncertainty, that is why you get paid a little more. There are other things that also determine why the option premium pricing is different. But this is one, longer time period is one of the factors. Right. Okay. So you choose the time period, how long you're willing to wait. And for waiting, you collect the premium money. And we looked at an example. If you sell a put option 30 days out, you're going to get paid $200 upfront. Advantages as compared to limit order, which we have been doing for years. Time is money, guys. Time is money. If you're locking your capital, make sure to get paid for it. There's a higher probability of profit. Stock goes higher, anyway you made $200. Stock stays the same, anyway you made $200. It can be profitable even if the stock goes against you, right? Look, we looked at the case of $59. You got $2 as a premium. So as long as stock is above 58, it doesn't go below 58, you are on a break even. So your break even is now $5,800. So that $200 is giving you a cushion in case the market corrects, in case the stock corrects, you have a cushion of $200. Right? So even if the stock goes against you, you can still be profitable. I love that scenario. I can't do that with stock. If I bought a stock at 60 and the PayPal goes to 59, I'm down $1 per stock. But if I had sold this put option and then got assigned at 60, my break even is 58 and not 60. Or it reduces the cost basis of owning the stock. That's other way put around is instead of your cost basis of a stock being 60, your cost basis is 58. I would want to have a cost basis of 0 so that, it's free and clear for me. It's like playing with the house money, not my money. And there are ways to do it. It takes some time. I have a few stocks in my portfolio where the cost basis is negative. What could be a drawback? Oh, I see only one drawback here. If a stock goes below 60 before expiration, you may not be able to get the stock. There are different factors that govern whether we put the stock or not before expiration. But if it stays below 60 at the end of expiration, you will definitely receive the shares. Say expiration is 17th May. Maybe what you are looking to do is PayPal doesn't pay dividend, but maybe you want to acquire the shares because of upcoming dividend. Then I won't recommend that you sell a put. because even if it goes to 59, let's say on 30th of April, if you had a limit order, you will get 100 shares in your portfolio. But if you sold a put, you may not get it. It depends. And the factors for later sessions, it depends. So, because I have sometimes on Twitter, I see many people getting, oh, my stock is below my strike price. I'm going to get a sign. Will I have to buy tomorrow? No, no, no. You may not have to buy tomorrow. It depends. So if you really want to buy it at, if you're thinking that a stock goes below 60 and you'll be assigned the stock immediately, that may not happen. That's the only, I would say, drawback. I won't say it's a drawback, but something that you should be aware of if you're selling a put. All these scenarios that we discussed were valid at expiration scenarios. Things could be before expiration, you may not get the stock. Okay. All right. So I think last one thing, and this is again, I added it after 2021 because I saw the retail investors got sucked into selling option premium because the option premium was huge. What you should not do is sell a put option because you just like the amount of a premium that is available. Remember, the premium depends on the amount of risk in the stock. And there will be stocks on which the premium is like 10% per month. Don't do that unless you like the stock. So premium is just an icing. So don't buy the icing if you don't like the overall cake, right? And for example, look at a GME, GameStop, right? The father of meme stocks or a mother of meme stocks. $11, you can get a premium of 94 cents. Or let's say take a midpoint, 85 cents. That's like 8%. I'm not going to sell a put on this because I don't like GME stock. In 2021, there were a lot of stocks which had a lot more risk in it, were giving a lot more premium, even higher than 8% for a month. And people got suckered into it just to sell option premium, got assigned the stock, and the stocks went to zero. And they had no idea why they bought the stock because got sucked into buying a premium, selling a premium. So my request would be, do this only if you want to buy the stock, only if you like the stock. Okay, option premium is icing. Make sure you like the flavor of the cake before you pick the icing, because the cake is going to matter a lot more in your portfolio than the icing. So takeaways, selling put is an acquisition strategy at a desired price point. It reduces the cost basis of owning the share by the amount of premium, right? I got $2 as a premium, hence my cost basis of owning PayPal share is now 58. I refer this strategy as transition because this was the first one that I used when I moved from just as a purely dealing in a stock onto the option world. This is how you take your 1 foot away from the stock world and keep it in the option world. Is I want to buy these shares. Let me sell a put option instead of buying the shares. Okay. Let's answer some questions. GTC, what's the time limit? It's good till canceled. Mike asks, if I want to sell a put option, do I need to have some funds on hand? Example, SPY $24.50 from now on. Again, Mike, it depends on what kind of option privilege you have. And for a beginner, your brokerage firm may not give you, let's say, margin account. Now, IRA, it will be only cash secure. then yes, you will need a funds against that put option. As you advance, the amount of funds that you need to keep will depend on the level of your margin that your brokerage is giving you. Okay? It could be 25%, could be 50%, could be 15%. So there is no one answer to it. Mike asks again, can I reinvest the funds, the premium when I sell a put? Do whatever you want to. That's money you have to keep. Go and get a beer or wine or maybe buy a stock. It's all up to you. You receive the premium. Just make sure that you have a $6,000. Don't spend that $6,000 because if the PayPal share get assigned to you, you will need that money to buy those 100 shares of PayPal. But those 200, do whatever you want to do. Costa K asks, I'm confused about selling puts. What's the difference between selling my position and selling a put option? Selling, completely different. Selling a position, you are selling your shares. If you are selling a put option, you are selling a right to someone else to put the share to you. So you're going to receive the shares if it gets assigned. Selling stock means you're taking a bearish viewpoint. You think stock is going to go down. Selling put is a bullish. Deepan asks, I only get 100 shares at 60 only put if buyer exercise, isn't it? Yes. And if at expiration, stock is below 60, you will get exercised. If it is 1 cent below 60, you will get exercised. So you will get the shares. Brokerage firms in US do an auto exercise if it is 1 cent below the strike price. You could also get the shares even before expiration. It is not that you'll have to wait until expiration. That depends on conditions. We will not talk about early assignments, I think, in an intermediate session. Is it safe to sell put options for penny stocks? If you love penny stocks, up to you. I don't like penny stocks. I don't deal in penny stocks that demand too much of attention. I don't want to build that lifestyle because it doesn't work with a regular job. So I have no opinion. Anonymous asks, how do we get paid that $200 as we are doing a put? The guy who is seeing the put get paid, maybe I missed something. No, so the moment you sell this, a put option contract, you receive $200 in your account. The mechanics behind it is a little different. I talk the whole mechanics of how it works in Saturday session. It's just how the stock works, right? Probably some market maker is doing it. Naresh asks, on downside, if a stock has runway to the moon, you wish you had bought the stock rather than waiting. But then you wouldn't have gotten during the limit order. Remember, I'm comparing the limit order. If you want the stock badly, right now, because the stock could go to moon, yeah, buy the stock. You have a zero margin of safety. That's why I'm comparing only with the limit order. Even then, and you know where I'm going, right? On the call option, so but different one. How do we get the stocks to our portfolio? Your brokerage firm will handle it. You don't have to worry about it. If you're selling a put option, you don't, and if it get assigned, brokerage firms will manage it for you. You'll get the stock, funds will move away from your account. You'll get the stock in your account. If you're buying an option and you want to put the stock, then you have to go through a process of exercise. Additionally, what do you mean that you will not sell a put option? I'm saying because I don't say sell a put option. Okay, this one, because don't sell a put option on penny stocks unless you really want to get a bullish exposure to penny stocks. Karthik asks, do we need to have $6,000 for 29 days or during the expiration should have amount? No, it depends on your option privilege levels. If your privilege level is that you need to have, you can only sell cash secured put, then the brokerage firm will block that $6,000. If you have a margin account enabled, then brokerage firm may block only $3,000. Means you can use the other $3,000 for something else, but on the day of expiration, if it get assigned, you will have to have $6,000. So it depends on option privileges. If you have a portfolio margin account, then brokerage firm will only block 15% of 6,000 for now. And you can use the other for others. Now we're getting into reg margin, portfolio margin, a much deeper topic. Do you suggest Merrill Lynch account or discount broker suggest TD for beginner? May I know the platform business class? I don't have any experience with Merrill, but TD Ameritrade is good enough. Now that has become Charles Schwab. So I've been using TD Ameritrade or now Charles Schwab. They have the best platform when it comes to options. I've heard Fidelity is also good, but I have no experience with Merrill. Merrill is generally a white glove service, so they're not for DIY investors. What is the difference between buy call and a sell put? Both are same in terms of premium. No, not same, but both are bullish. But they are different. I mean, when we discuss call, we'll talk about it. And then we'll fill up this PC box, which will tell you what exactly what is. What is the best, Srini was asked, what's the best platform for options trading? I mean, I use two. One is I use Thinkorswim, which is now from Charles Schwab. Or if you open an account in TD Ameritrade, they're getting merged into Charles Schwab. Or the other one is Tastyworks. I've seen some people using Robinhood. I don't like because you don't get a good pricing in Robinhood. And number two, as you get a little more serious about options, your Robinhood doesn't present you with a profit and loss graph. You can't simulate some of the thing. You can't see what your break-even points are, which is what you can do on Thinkorswim. The other one is Tastyworks. That's also pretty good. So I use these two as my trading platform. I don't work for any of these firms, so you could pick up whichever you want to. Wish to have more practical for initial class to get confidence on using platform. Any site to learn practical skills. So whichever brokerage firm you are with should have some videos around how to. So I'm not doing any session on working with your trading platform because there are so many trading platforms. But reach out to your broker. They should have some videos on doing certain things specific to your platform.